Coca-Cola reported $12.4 billion in EBITDA in 2023. That same year, it reported $11.3 billion in EBIT and just $10.7 billion in earnings. Why are there so many different ways to measure a company's profits? And which profit metric is best? In this video, I'll explain what each of these terms mean, how they're different, and which one investors should pay attention to. Hi, my name is Brian Feraldi. I'm a financial educator with 20 years of stock investing experience. Let's start with a company's earnings. Now, this number shows how much accounting profit a company made during a specific period. It's found by looking at the income statement, and the formula couldn't be simpler. It's simply the company's net income. So here, for example, is Coca-Cola's income statement. If you look at this number right here, net income attributable to shareholders of the Coca-Cola Company, we see that Coca-Cola reported $10.7 billion in earnings during this period. Now that name, earnings, is synonymous with the words net income and profit. Now, an important thing to understand about the income statement is that it uses accrual accounting. Now, what is accrual accounting? Well, with accrual accounting, revenue and expenses are recorded when they occur, not when payment is received or made. When looking at Coca-Cola's income statement, let's take a look at the company's revenue, which it calls net operating revenue. We can see the amount of revenue that Coca-Cola generated during these specific years. Now, when focusing on 2023 in particular, we see that the company generated $45.7 billion in revenue. However, because Coca-Cola uses accrual accounting, it may not have received that $45.7 billion in cash that it recorded as revenue during that year. That same idea applies to all the company's expenses as well, such as cost of goods sold, operating expenses, interest expenses, and income tax expenses. While the company recorded this much expense in each of these specific years, it may or may not have resulted in an actual cash payment during that specific year. Now, that's especially true of these two expenses, cost of goods sold and selling, general, and administrative expense. Included in these expense numbers are non-cash charges. Three of the major non-cash charges every investor needs to know are depreciation, which is the gradual writing down of the value of a tangible asset like a factory; amortization, which is the gradual writing down of the value of an intangible asset like a patent or copyright; and stock-based compensation, which is paying an employee with stock instead of cash. Each of these charges are recorded as expenses on the income statement, but they do not result in a cash outflow at that time. So when looking at Coca-Cola's earnings, it's important to know that this number is calculated using accrual accounting, but the company's actual cash generation may or be higher or lower than this figure. Now, why focus on a company's earnings? Well, it's an extremely widely used profit metric, and because it uses accrual accounting, it smooths out some of the company's revenue and expenses to show a true profit figure. On the downside, accountants have a lot of leeway with how they record expenses, and because of that, their net income can be distorted. Moreover, one-time charges or non-recurring charges can often severely impact the company's net income figure. That brings us to our second profit term, which is called EBIT. Now, EBIT is simply an acronym that stands for earnings before interest and taxes. EBIT is a shorthand for showing a company's operating profit, or more simply, how much profit the company generated simply from operating the business. It's also found by looking at the income statement, and the formula is very simple. It's net income plus interest plus taxes. So when looking at Coca-Cola's income statement, we start by looking at the company's net income, then we add back in the company's income tax expense, and then we add back in the company's interest expense. Now, more recently, when trying to figure out a company's EBIT, we also have to add in non-operating income and expenses such as equity income and other income to this number. When we do that math, we end up with this number here, operating income of $11.3 billion. So Coca-Cola's EBIT was $11.3 billion. That word is a synonym for the word operating income. Now, just like earnings, finding EBIT uses accrual accounting. Now, one big pro of using EBIT to measure profits is that it focuses on the company's operation. Moreover, if you have a debt-heavy business, since we're ignoring the impact of interest, you can get a better sense of a company's true profitability. On the downside, with EBIT, we're ignoring a company's interest expense, which for many businesses can be a very real and big expense. And in addition, just like with earnings, because we're using accrual accounting, it can be manipulated by skilled CFOs. That brings us to our last profit term, EBITDA. Now, EBITDA is simply an acronym that stands for earnings before interest and taxes, and also depreciation and amortization. Now, EBITDA is a shorthand for showing how much cash flow a business is generating through operations. Some companies report their EBITDA right on their income statement, but others force you to look at the cash flow statement to get this number. Now, the formula here is a company's net income plus its interest, taxes expense. In addition, we also have to add back in depreciation and amortization expense. So the accounting method that we use here is accrual accounting and cash accounting. Now, what is cash accounting? Cash accounting means that transactions are recorded only when money moves in or out of an account. To measure how much money is moving in and out of an account, we look at a company's cash flow statement. If we look up or down the cash flow statement, we see how much money is moving in and out of a company's bank account due to various categories. Now, most companies, including Coca-Cola, break out their non-cash depreciation and amortization expense right on their cash flow statement. So we can use this number to calculate a company's EBITDA. So in Coca-Cola's case, we start with the company's EBIT of $11.3 billion, and then we add to that the company's depreciation and amortization expense of $1.1 billion. So when adding those two figures together, we get $12.4 billion in EBITDA for 2023. Now, as you may have noticed, not all companies use these exact terms and categories when they're creating their financial statement. In fact, I've seen companies call their operating income operating profit, operating margin, and business income. And I've also seen companies call their net income the bottom line, income, or earnings after tax. Now, the same is true for all three financial statements where management teams have lots of leeway in the categories and terms they use to create their financial statement. If you want a handy summary of all the terms that can be used, I created a free ebook called Financial Statement School that lays out all of the synonyms that you might see. If you want a free copy, simply visit longtermmindset.co/FSS ebook or click the link in the video description. Now that we understand what these profit terms mean, which one should investors pay the most attention to? Well, the truth there is that depends on what type of investor for you, but here's a good way to think about it. When thinking about the income statement, the most useful number on here from a profit perspective is earnings, or the company's net income. This is the number that you should be relying upon whenever possible. However, in some cases, a company may have a higher or lower tax bill than normal, which could distort the company's net income figure. In this case, it might make sense to look at a company's EBT, or earnings before tax, to eliminate that tax figure from the company's earnings potential. Now, in other cases, a company might have non-operating income and expenses that are causing the profit figure to be wild in one direction or the other. In that case, it makes sense to eliminate that from the number 2 and focus on a company's EBIT. In other cases, a company might have a higher than normal depreciation or amortization expense that makes its EBIT less useful. And in those cases, it can make sense to look at a company's EBITDA as a rough proxy for its profitability. And in still other cases, it can make sense to ignore all these numbers together and focus on other profit metrics, such as a company's net operating profit after tax, or NOPAT, a company's free cash flow, or a company's owner earnings. In Warren Buffett's case, when he analyzes a business, he likes to focus on a company's earnings before tax and owner's earnings instead of just looking at its earnings by itself. Now, if you want me to make a video that explains those other profit terms I mentioned in more detail, I'll give this video the thumbs up. If it gets 1,000 likes, I'll go ahead and make that video. If you want to keep learning from here, I highly recommend you watch this video I made, which shows the 10 most important metrics for investors to watch next.